right, good morning. Today is January 4th, 2023, and it's a new year. New year in the stock market. Hope everybody had a good holiday season. It was good here. Other than we had a we had a cold snap, which I'm sure just about everybody listening probably did. That cold snap was pretty fierce. Three hard freezes in a row. So very unusual. But the good news is things are looking up because it's close to 80 degrees here. And so things are looking up. So, boy, where do I even start? I guess since it's the new year, and today, of course, is only the second trading day of 2023. So this is kind of a holiday shortened week too. It takes everybody I've noticed over the years it takes everybody a little bit of time to sort of get back into the groove of things after the holidays. And so, Monday the market was closed. Yesterday market was down a little bit. Seemed like kind of a rough start. Typically people think that first new day of the year, a bunch of money's going to come into the market and people are going to buy a bunch of stocks and that to start the new year. But what I kept thinking yesterday, it was pretty weak. Of course, the S&P is like trapped in this big trading range, which we'll look at for a minute. But what I kept thinking yesterday is that people were selling stocks because they weren't going to. It was the first day you could sell and not have to pay tax on it until 2024 on gains. And so I think people might have taken that opportunity to lighten up. And of course, some of the big cap, mega cap stocks are starting to get hit pretty hard here. So before we dive into that, I wanted to bring up this slide that I saved off the internet. Someone named Charlie Bellio or something like that. It's pretty interesting. Obviously the stock market has more stats than Major League Baseball, and people love to look at stats and what happened and all that historically. And so what's actually kind of cool about this is, this goes back to 1928, right? And so it's interesting to see depicted graphically what the returns were by year. And yeah, I don't know if this is a couple days before the end of the year or whatever. Everywhere that I look, it seems like I see a different statistic for, the exact amount that last year was down. So somewhere between, 18 to not quite 20%, although the intra-year drawdown was over 20%, but I guess it depends on whether you use the I've always used like the intraday highs and lows for whatever reason. I've always just kind of liked that. If you use a line chart, if you use close to close, you're gonna end up with a different number. So that might have been what he used here. But anyway, the interesting thing to note is that only during like there's not very many years. My YouTube thing says that it's blanking out, so hopefully the stream keeps going. Hate when that happens. And nothing's changed here. I haven't had this problem in a while as far as internet goes. My internet speed should be perfectly adequate, but it says YouTube's not receiving enough data to stream the video. I don't know. Anyways, we'll see how it works out. Maybe they can fix it on the replay. But you don't see a whole lot of spots on this chart where there were 2 years in a row down years, right? Look at the most recent data here. The last time we had a few down years in a row was, and quite frankly, I mean, look at 2008. That was definitely a big deal, right? I mean, 2008 down 37%. So, um, but if you look back here, I mean, it's been all the way since the dot-com meltdown that we actually had a couple of years in a row, 3 years actually in a row down. So anyway, when you look at this, 73, 74, I think was like the big inflationary environment, all that kind of stuff. Um, Obviously this was the Great Depression. This was bank panic stuff. Interestingly enough, these weren't really that bad of down years, although there was three in a row. I mean, minus 1.1% is basically flat. So anyway, it's just kind of interesting to look at this and to see the historical returns by years, especially going back that far. That's kind of the interesting thing. So, um, 2 down years in a row is relatively, it doesn't happen very often. It doesn't happen very often. So what will this year bring? Hey, who knows? I guess we'll find out. So, and I'm seeing lots of predictions out there that, you know, they some people expect the first half to be bad and the second half to be good and vice versa. And then there's, the Wall Street price targets last year missed significantly. And so this year, everybody's tamed down expectations. I found a graph that I thought was really super interesting. Um, and it was along the same lines as this chart here. And what it was is it was sort of it was a distribution of, all these years plotted on a histogram. And the funny thing is that even though the markets, average a certain amount, like 7% or say over this period of time, each year, the interesting thing is that very few years out of this, and you can actually see this, the market was up, like, the average, I guess, is what it was. So it's hard to describe. I'll see if I can find that graph again and bring it. But basically, a typical year is up way more than the average, or down more than the average was sort of you can see. So if we're down 18% one year, and then we're up, say, 15% the next year, or 13%, we're not even back at even yet. So that's something else to consider. And it kind of makes sense when you have a big down year that it's followed by an up year. But anyway, just kind of interesting. And so there's lots of ways that one can look at this, but I think you get my point. So anyway, I wanted to jump into first look at the weekly chart, right? And the interesting thing about this weekly chart, I mean, there's a few interesting things. I guess I draw my trend line on there. So that's basically the same trend line we've been looking at all year long. And there was one little poke above the trend line. This little poke above the trend line occurred. Let's see if I can get it close enough. That little poke above the trend line occurred when the CPI number came out, right? Remember that? The CPI number came out and the market had a huge rally. And then literally the following day, Jay Powell threw cold water on the idea that the Fed was going to pivot anytime soon, because, I mean, inflation was, what, 7.1%? And even though it had come down and that number beat the expectations, 7.1% inflation year over year is nothing to cheer about. Where we are right now is kind of interesting because, like I said earlier, the market seems to be trapped in this sideways sort of range for the last few weeks here, and roughly 3,800 to 3,900. And so it's going to be interesting to see if to see which way it breaks from here, right? And that's a little more. One more thing before I zoom in on this chart. If you take the pandemic low back here, and the all-time high, which occurred, right at the beginning of the year last year, that 3,500 level was just about a 50% retracement of it, right? And so, you can see the pandemic high right there was, let's see what that was, just off the top of my head, about 3,400. So, this high right here was 3,393. So just call it 3,400. So it's kind of interesting that this low right here, the low of like the current downturn, compared to the all-time high that happened right prior to the pandemic sell-off, we're like 100 points apart, right? 3,400, 3,500. So let's flip over to a daily chart here and kind of take a look at this trading range. So if you look at this particular trading range, you guys remember, back over here, it was a similar sort of thing. There was a similar sort of period of time where the market had like rallied up and then just chopped around in a sideways range for, it looks like 2, 4, 6, about 7 days, and then started selling off. This little range we got here is it almost seems tighter. There's a couple of pokes above and below it, and of course this is the holidays too, right? And so you don't really expect the market to make a big directional move over the holidays. And so what I'm thinking is that, there's a couple things that can happen here. And let's see. Let me just try this just for the fun of it, because now I have this new little tool at my disposal where I can draw on the chart without skewing things. So thank you, stock charts. Right? This is exactly what I've been sort of asking for quite some time, is a way that I could mark up the charts live without going through all that rigmarole as far as like having to expand the chart and contract it and that, because it just kind of threw everything off. But anyway, so here we are. All right. Call it 3,800 to 3,900. Obviously, it's there's been a few little pokes below 3,800, but this little consolidation box is similar to some degree to that one. And of course, obviously it doesn't mean that this one's going to break to the downside like that one do. Although today the Fed minutes come out. There's a couple interesting things about today. Is one of which is there was an article that Neil Kashkari, right, one of the Fed guys, came out with an article talking about, why they blew it on inflation, and this whole thing about inflation. It was kind of interesting, interestingly enough, he said that the article, which I read this morning, said that basically that what the Fed's plan is, what they don't want to do, is prematurely lower interest rates or pivot, as they say. There was a lot of these rallies, especially this one in the fall last year, was sort of predicated on the idea that the Fed was gonna, stop raising interest rates and lower them. And they keep saying they're not going to do that, right? They're going to hold interest rates higher. And the other thing he said in the article was, he was looking at like 3 more rate hikes or whatever, and a terminal rate of, I think, 5.5% or something like that. So, it's funny, because if the market itself took him seriously, then it seems to me that it would have been down a lot this morning. But of course, he's been wrong about just about everything as long as I can remember. So, but all this time, all these Fed talking heads come out and they say, look, we're we're going to raise rates, and then we're going to hold them there until we, know for a fact that inflation is defeated. Those were his exact words. Is he doesn't think that they want to, pivot until they're absolutely convinced inflation is defeated. And so, barring some sort of like, really super bad recession or whatever, and Wall Street still thinks that the Fed's going to slow down or whatever. So I'm not sure. I honestly didn't think that going into the new year that they'd be looking at like 3 more rate hikes. Just say 50 basis points. So I don't know. Anyway, today the Fed minutes come out at 2 o'clock, and so that's gonna give the market a little bit of insight into, I guess, what their thinking was, last meeting or whatever. But it's a pretty interesting chart. So, I mean, it could go either way. Here's the main thing about this trend line, right? I mean, every single buddy that, looks at stock charts has got the same exact trend line. They've been looking at it all year, and so have we. But, it is the major trend. This is the primary trend of the market right now, which is down. And it just so happens that we're kind of trapped in this little box right here, which is going to break one way or the other. Here's the thing, is that I've said this many times. The thing about technical analysis, some people kind of take it too far. Obviously, it doesn't predict what the market's going to do or whatever. I mean, you can use it in a lot of different capacities, but there's one sort of law of physics that comes along with technical analysis in a chart like this. Like, the law of physics is this: the market can't get back to the highs until it trades above that trend line. I mean, that's kind of it's so obvious it almost doesn't need worth stating, but that to me is the main value of these type of things, of using that trend line as sort of a line in the sand, so to speak, as far as what the market has the potential of doing. So anyway, that's basically it. So my point is, if this thing breaks to the upside and breaks above that trend line, then there's all sorts of overhead resistance, I guess is what they would say. So last year was a really tough year for everybody, and the idea is that, and especially, we've looked at some of these stocks that are down significantly, and so the idea of overhead resistance is, suppose the market does decide it wants to rally and it comes up and it breaks that trend line, all these levels on the way up are places where, people would have bought, and theoretically, and it works the same way with the stock, there's all these levels where people bought in, and then they took a drawdown, and, and the stock or the market went against them, and so in their minds, they're thinking, well, boy, if this thing just can rally up to, where I'm back at even and can get my money back, I'm going to go ahead and sell because I think it's going even lower, And so that's the idea of overhead resistance. The buyers want to, they want to get back to even, or haven't been down all year or whatever. If they can get some of their money back, then maybe, they're like, if I just get my money back, then, and so that's the concept of it. That's really the concept of it. This is going to be interesting because, hey, maybe we get a couple of more days here. So the thing about these consolidation areas that's also interesting is this, and this little break above the trend line, like a little fake out, is a good sort of reminder that it can break out of this box on either side and then not get any follow through and like fake everybody out, right? Like, let me expand this a little bit. There you go. So you got this box here, and say it breaks out to the upside here, and pokes up here a little bit. a couple of days later, you could get a total reversal. Now, obviously, here's the thing is like when you get a consolidation like this, when it does break out in one direction or the other, you can always trade in that direction and just put a stop, just under the lows or the highs in the opposite direction. And so, but there's no guarantees on that, right? Like there's no guarantees, but if you're going to get a significant move in either direction, then, buying on the breakout, whichever direction it is, buying or selling on the breakout, going long or short, it really, is sort of the key. And, you get faked out on the little pokes. So that's worst case scenario. And so it's completely viable, right? The other thing that this basically is telling us is that the market's kind of in balance here, right? Like somewhere between 3,800 and 3,900, I guess is what all the participants has determined as fair value at this point. They say that the efficient market hypothesis says that everything that's known is in the market, right? And so until, some other news comes along, personally, I think that, and I hate to say this, but I think that the market is, never question the market, but I think the market's a little bit delusional because all I heard for about the second half of the year, probably this rally here was probably based on a Fed pivot. So it's like the market is trying to call the Fed's bluff. The Fed keeps saying, "Look, we're going to keep raising rates. We need to see inflation come back down towards 2%. We need, definite proof that we're not going to take our foot off the pedal until we know for a fact that inflation is defeated." That's what Kashkari said in his article this morning. Until they're sure inflation is defeated, they don't want to make the same mistakes that apparently have been made in the past, where they raise rates or whatever, and inflation comes down a little bit, and they think, we did it, mission accomplished, and then it comes roaring back, right? And so that's the one thing that they just keep repeating over and over, and the market is pretending like it doesn't hear that. It's pretending like it's like, and with good reason, because over the years, what they say and what they do a lot of times are two different things, right? So it'll be interesting to see. And of course, the other thing that we got going right now is, all right, so let's see here. Let's take a look at Apple. Let's zoom out on this chart a little bit. So we're kind of at this point now where, like, the big cap, the generals as they call them, the big cap stocks, the mega cap stocks, the hedge fund hotel stocks are not looking so hot, right? I mean, yesterday Apple got hit pretty hard, and it hit like a 52-week low or whatever. I mean, you can see the high up there, and then you can see where it is now, and so that's kind of a nasty chart. That's a toppy looking chart, and today it's Microsoft, right? I think Microsoft got downgraded, and so that's not the prettiest chart either, right? And same sort of thing. Big trend line like the market, and of course, Tesla seems to be one of the stocks that seems to be the most talked about, right? And look at this thing. I mean, I forget what the number is, but I'm sure you saw the statistics about, $10 trillion was wiped out of the market last year or whatever. And I don't know if that's globally or whatever. But anyway, you can see that these, a lot of these mega cap stocks, especially mega cap tech stocks, have been hit pretty darn hard. And the 52-week low list, and this is the one, I think we looked at this last week, Amazon. Geez. this one's kind of a mind blower to me anyway, because Amazon's trading around. There's the pandemic low, right? I mean, most of these mega cap stocks are still, kind of up above like the high prior to the pandemic or whatever. But to see Amazon having retraced that is kind of interesting. So, and obviously, there's kind of an area of support for this. But when you look around at these particular stocks, now obviously the bright spot, see, was it ExxonMobil? Yeah, big bright spot. The Dow stocks, a lot of the Dow stocks did pretty well. They've fared very well. So this was one of the bright spots. Of course, if you look at the chart here, starting in 2022, it was kind of, it didn't do a whole lot in 2021, and so it just took off in 2022. So, and then there's some other ones like some of these Dow stocks like P&G. P&G, held up relatively well, I would say, because of like this year-end rally, and there's a couple other ones. I think Caterpillar held up, yeah, hitting new highs in that. So, I mean, it had a kind of a rough 2021 and a rough year to start last year, but then a lot of these things had the year-end rally, and I think it was money coming out of the big tech stocks and going into perceived safe stocks. The other thing is everybody says that the whole thing about the soft landing and the recession, and there was a Barron's cover last year. That said we were already in a recession, right? And then there was all the debate about whether we were in a recession. And so, if I'm not mistaken, the Atlanta Fed GDP numbers came out recently in the last few days or week or something that said they're looking for 3.9%. I think it was 3.7, 3.9% GDP growth, right? So it's a whole different ball game when it comes to tech stocks in the Nasdaq. And interestingly enough, the Nasdaq 100 is still just like the S&P. Nasdaq 100 is still above the pandemic highs, right? That high line right there prior to the pandemic, which basically changed everything. It's another conversation, but the entire dynamic of the market changed because of the pandemic, right? And the fact that the Fed slashed rates when this happened, it happened fast. The S&P sold down like 35% in a very short amount of time, and obviously, a global pandemic and shutdowns and lockdowns and all that, the Fed panicked, slashed rates to zero, and threw trillions of dollars into the system. And that accounts for, that has to account for a lot of that rally and subsequently, the inflation. So, but the interesting thing about the NASDAQ 100 is, the S&P's had a really good bounce off of last year's lows, right? Like, there's 3,500 on the S&P, and we're bouncing around 3,900 here. Well, the Nasdaq hasn't fared nearly as well. It's still like sort of plumbing the lows. So that's kind of interesting. The money last year gravitated towards the Dow, which ended the year only down about 7% or something. I mean, obviously, what's crazy about it is that like prior to the sort of mid-December sell-off there, the Dow was just barely even down on the year. So that's kind of interesting, but it was, no matter how you slice it, it was a really nasty year. And one of the reasons it was such a bad year is because typically investors are, they're in the high growth names in the big caps and all that stuff. And of course, we hardly ever do a show without taking a look at ARK here. So this is kind of this is the poster child for, what a real downturn looks like in the market, reminiscent of the dot-com days. And I don't even know what to say about this, to be honest with you, because the types of stocks that she's loaded up with in this ETF may or may not be viable long term. So it's kind of like, well, like Zoom comes to mind, right? The reason that, and it's probably better to look at weekly charts on this stuff anyways. So, I mean, I went to ARK's website because they had published an article about, or published a research paper about why they expect Zoom to be a $1,500 stock, right? And I look at this chart and I think to myself, well, geez, this kind of reminds me of a chart during the dot-com bubble. And so, what are some of the other stocks they're loaded with? Roku is another one. And so, I mean, if a stock goes from 500 to 50, just under 500 to 40, you don't know if they're ever going to recover, ever. And there's so many of those. Then there's like Coinbase, right? Remember all the hype surrounding the Coinbase IPO? Or some of the other ones. I don't know. She owns a bunch of Tesla too. I think that was at one point that was their largest holding. But anyway, the types of stocks that high growth, high momentum, stocks that a lot of them don't make any money. Goldman Sachs has an index of money losing tech stocks or whatever, and it looks very similar to this. So that's basically, and so kind of what the lesson of last year is when the Fed embarks on a rate hike cycle, and go back to the S&P here. When the Fed starts hiking rates and they embark on a Fed rate hike cycle, and the other thing is they're reducing their balance sheet, right, which is a big deal. Over the years, we've seen lots of charts that have like a correlation between the Fed's balance sheet and the stock market, right? So there's got to be a correlation there. So anyway, who knows? It's really difficult to tell at this point what happens, because even though in the back of my mind I want to say that this thing sort of zigzags and comes back down, but never underestimate the idea that investors and money managers are delusional, right? And so, as bad as the macro picture might sound, I see them all day long. They come on CNBC and they make a case for a rally. And so, it really depends on what people do with their money. If money comes into the market based on whatever, based on the idea that I joked about this earlier in the year, that everybody was looking past inflation and they were looking past all the interest rate hikes, and looking past a potential recession all the way to the other side of that, when interest rates are coming back down and the recession's over and inflation's tame or whatever, and using that as a reason to be bullish and buy stocks. And so it's kind of and I mean, I've honestly seen guys come on CNBC and say, "Oh yeah, well, we're looking past all this bad news to, when all that stuff's over." But the thing of it is that when it's actually happening, it hasn't even happened yet, a lot of it. So it's hard to kind of look past it, but it could happen, right? So I swear I saw an article yesterday that one of the big banks, or maybe it was a foreign, but I think it was Deutsche Bank, if I'm not mistaken. Deutsche Bank expects the market to rally up in the first half of the year and then tank in the second half of the year, something like that. And I think they were talking like 4,500. I mean, it seemed like a really outlandish sort of prediction to me, anyways. It seemed it was really complicated for one thing. The more complicated the prediction, the more likely it is to be wrong. But I could have sworn that they said they expect the first half rally to like 4,500 and then a 25% drop or something like that. So, um, yeah, I don't know. I really don't know. The most instructive thing at this point will be to watch for a breakout in one direction or the other of this box. And a lot of that, I think, a lot of what drove the market last year was the perception of what the Fed was going to do. And so keep that in mind as the Fed minutes come out today. And I don't believe, I think it's like February when they have their next interest rate announcement. And I guess the expectations are they're going to raise 50 basis points again. But I think I don't keep up with that stuff. Plus, it's been the holidays, and so I've been so busy with other stuff that I'm just starting to get back into the groove of things here. So I'm not really sure what to expect, quite frankly. I do know this, that the S&P 500 is kind of masked. One last thing, let's look at the monthly chart just for the fun of it. And of course, you look at a monthly chart, typically you want to switch to a log chart. I'd probably take this off of here. Should probably take my boxes off of there, but oh yeah, well here's the thing about the monthly chart, right? So it's a good thing I left this on here. You can see that here we are. We're the second trading day into the month, and there's a couple of big levels on this chart. And so speaking of overhead resistance, let me go back to speaking of overhead resistance, like if the market does decide that it wants to rally in January, and that's just sort of an approximation. I didn't really. There we go. That's not too bad. I just wanted to draw like what I consider to be major overhead resistance there, and you can see. Sometimes I like to look at like the monthly, the longer term chart. So it looks like, let's see, the high this month was 41.19, so call it 41.20, and the high last month was 4100. So so basically 4100 is a major overhead resistance level, which I tried to draw on here using like a little rectangle, but I think you get the point. So even if we do rally up, somewhere around that level there is that's really sort of the level to watch. And so my point is that if I draw that trend line down across the highs, there's really two things the market needs to overcome in order for everything to sort of get back to normal. And that is, first it's got to break above that trend line, and then it's got to get over that overhead resistance right there at 4100. So first it's got to break over 3900, right? Then you get the overhead resistance at the trend line, and then that's the major level. And so that's kind of, and of course there's always the possibility that this thing breaks down from here, in which case you got your support down here between 35 and 3600. And so really, rather than try and predict which way it's going, the idea is just to have sort of, all these reference points. Boy, it's amazing how that trend line fits so well on all the different time frames, even the monthly chart. So I wouldn't read too much into this week. I think next week is when we'll get a little bit of an indication about I think we'll get a better read on, better read on what happens next week, just because this is still kind of a holiday week, you know. That's interesting. You know, I draw something on the monthly chart and then go to a daily chart, and man, you can really see that you know that level, those levels I drew really, you know, really do sort of encompass the major overhead resistance. You can see this spot way back over here, and you can see these highs here, and so that the trend line may not be all that accurate as far as well, the trend line's not that accurate when you go from a monthly chart to a daily chart. It needs to be, there we go. You got to adjust your trend lines when you switch time frames like that. But so anyway, you know, that's basically it. I don't like really super complicated charts either. I mean, this is about as basic as it gets. You got your major downward sloping trend line. Then if that trend line gets broken, you know, you got your major overhead resistance that the market would need to chew through. And of course, there's a bunch more resistance levels. And as we sit right now, we're in like this huge consolidation phase. And, you know, in theory, the longer that the market stays trapped in a consolidation area like this, the bigger the move is when it breaks out. So anyway, keep your eye on the breakout of this box, and I will see you back here next week, same time, same place.